Hello traders, welcome to another episode. In this video we are going to learn supply and demand in a candlestick. Have you ever wondered why the prices move? In any financial market, the price is the result of supply and demand. If the demand exceeds the supply, the total trading volume of buyers is greater than the total trading volume of sellers, causing the price to go up. Conversely, if the supply exceeds the demand, the total trading volume of the sellers overcomes the total trading volume of buyers, causing the price to go down. It is useful to analyze the Forex market in terms of supply and demand. I also like to analyze the Forex market referring to the constant battle between buyers and sellers. How can we study all of this in a simple candlestick? If you have taken the course about Forex candlesticks, you are a step ahead. If not, we will mainly use three categories of candlesticks in this course: pin bar, long-legged doji and marubozu. Let's focus on the pin bar first. A pin bar has a long lower or upper shadow and a small real body. In case of a bullish pin bar, we have a long lower shadow. In case of a bearish pin bar, we have a long upper shadow. What can we say about these two candlesticks? The bullish pin bar shows that, at the beginning, sellers were in control. The long lower shadow shows that the price was going down during the session, but buyers reacted and pushed the price up to close near the opening price. So, at the beginning of the session that formed the candlestick, sellers were quite strong. By the end of the session, buyers were stronger than sellers. That's why this is a bullish signal, because it shows that buyers ended the session in control of the market. What about the bearish pin bar? The long upper shadow shows that buyers pushed the price higher during the session, but sellers reacted and the price closed near the opening. In this case, sellers were stronger by the end of the session. That's why this is a bearish pattern. If you want to study more in details these patterns, I will recommend some sources in the next lecture. But for the purpose of this course, what I want you to understand is the logic behind any candlestick. I don't mind if you don't remember any name. I want you to start to have a logical approach to candlesticks, so you will be able to analyze and understand any single candlestick, even the ones that do not form any pattern. The second important candlestick is the doji. Specifically, I want to mention the so-called long-legged doji. A long-legged doji has many characteristics. No real body, or a very small one. The opening and closing price are in the middle of the candle, and then it has long shadows, at least longer than the small real body. How should we analyze this candle? This candle expresses indecision. The two shadows show that the price went up and down during the session, but it closed more or less at the opening price. So it's been a fair fight between buyers and sellers. Last important candle that we need to mention before starting to study the strategy is the marubozu. A marubozu is a candlestick with a longer real body and no shadows. When the candle is green, we have a bullish marubozu. When the candle is red, we have a bearish marubozu. It's very easy to read a candle like this. It is a sign of strength. The bullish marubozu indicates that buyers were in control from the beginning until the end. The bearish marubozu indicates the opposite. Sellers were in control right from the start. Since a perfect marubozu is not easy to find, we will also consider the opening marubozu and the closing marubozu. An opening marubozu is a marubozu that opens without forming any shadow. A closing marubozu is a marubozu that closes without forming any shadow. The logic is the same, they both indicate strength.